Web. Okay, that's a little beep telling me it started recording.
Yeah.
Okay. Whoops, and I pressed the B key, big mistake. Okay, this is Minsky. If you haven't seen his face before, he's the guy whose research I've been trying to turn into a systemic analysis of capitalism, and that's the T-shirt symbol for the Minsky software that I've developed, which was partially funded by a grant from the Institute for New Economic Thinking, but they gave me half the money I asked for, usual story, and asked me to do twice as much as I contracted to do in my application. So I then had to raise additional money, which I did from the public with a Kickstarter campaign that raised about, $78,000 through a Kickstarter, but about another $20,000 off screen. So that's where Minsky came from. And what I want to talk about first of all, I know you want a major objective here is to build a more economically thorough version of World 3. So I want to talk a bit about the role of finance as I've been asked to, and why does finance end up being so significant in modern capitalism. And if you look back to the 1960s, and can we see any more of that? We're going to lose a bit of the title. Well, that's okay, I think.
That's the problem.
Not too bad.
Of course, you can use display, PowerPoint or something.
That's fine. It's only I don't have any text up there particularly.
We can almost read it.
Yeah, that's good. Okay. If you look back to the 1960s, President Dwight D. Eisenhower coined the term the military-industrial complex to talk about the power of the military and the mixture between the two and how that dominated capitalism. We fast forward, in many ways I think in the 1970s people thought information technology would take over as one of the dominant industries, but in fact IT is subservient to finance. Finance is by far the dominant industry now, and the IT's role is largely influenced by the needs of finance more than anything else. And I wonder if a certain 19th century philosopher had a reason as to why, because if you read more than chapter 1 of Das Kapital, you'll come across this one, and it's this set of statements in chapter 2. And this is Marx, is normally regarded as somebody who doesn't talk about money. For people who don't read enough of Marx, you see him making these statements here. Talk about centralisation. The credit system constitutes enormous centralisation and gives this class of parasites the fabulous power not only to periodically despoil industrial capitalists, but also to interfere in actual production in the most dangerous way. And this gang knows nothing about production and has nothing to do with it. That was, of course, that's just straight notes writing on a sheet of paper, because this was not a volume that was finished for publication by Marx. It was later published by Engels. So this is literally how he's just writing in anger one day in the British Museum. But you can see that he thought very seriously about the role of the financial sector, and talk about that periodic thing. He really is talking about every now and then, for some reason, they come to dominate capitalism. And then talking when he's writing again, this is also in volume 2 of Capital, he's saying that and I love this phrase, saying a high rate of interest can indicate, as it did in 1857, which is talking back about a previous time where there was a financial crisis, that the country is undermined by the roving cavaliers of credit. Beautiful phrase. I use that quite regularly. And he said, meanwhile, they live in grand style on anticipated profits. So what we're seeing happening with Goldman Sachs and that crowd today is it's new in scale, but not new in nature. This has happened many times in the past. And the question as to why it happens, again, further of Marx in that same chapter in Capital, the fact that returns become totally separated from the physical flows. The finance gets a huge part of the share of output, even though it's contributing very little to production. And in fact, if you don't have a critical perspective, you can see finance as an essential part of production, whereas Marx is saying it's actually a parasite. Now, I wonder whether this might be part of the reason why. This is looking at the long-term data from America and England on the ratio of private debt to GDP. And you can't read the numbers there, I'm afraid, but the top of the scale there is 200%, so twice GDP. Down here you've got 0, that's about the 100% mark. The American data, I had to take Federal Reserve data, which goes right back to 1952 or 45, and you can get it back to 45, 46 with annual data. Then there was census data. So if you've ever seen the census data figures, they will show a debt level way up here somewhere. But when you look at where they overlap, the overlap of the census data and the Federal Reserve data is very, very tight. So I rescaled the census data to fit the more recent and more thorough flow of funds data from the Federal Reserve, and that implies that the peak level of private debt back in the Great Depression was lower than the peak level we've got right now. Now the English data, which comes straight from the Bank of England, That's a recent, very, very good data set that they've produced called 3 Centuries of Economic Data. It's a freely downloadable spreadsheet from the Bank of England website. Highly recommend getting hold of it. That's their long-term data. And they've published the data from 1963 on is now being published by the Bank of International Settlements. So that data is quite, very, very well based. And yet when you tack on the previous data, you get this pattern that there was no particular trend in the English in terms of going up or down until 1980-81, and then bang, going from about 60% of GDP to 200%. And of course, when you get this much debt, the banking system dominates capitalism. And that's what I think we've been through. And we are now trying to change the nature of the ecology at a point where finance is at its most powerful, but also simultaneously at its weakest, because it's dependent upon that level of debt growing over time. And there's simply, as you can see now, at least in England and America, there's not exactly a trend of growing debt. Okay, so they've reached saturation point in that sense. Now, where does that come from? Well, Minsky, I think, gave the has anybody here read any of Hyman Minsky's work? Okay. A bit, okay. If you want to have a really easy read, you can find a lot of papers on the web these days. But if you want to read buy a book on it, the best book to buy is a little book of readings called Can It Happen Again? And they're 15, 20-page essays. He writes beautifully in a concise format. And they're very, very readable and very powerful. One or two of those and you'll understand 90% of what he's talking about. If you want a book-level treatment, the best book is one that sounds like a biography. It's called John Maynard Keynes. It is not a biography, okay? It is. He called it that title in tribute to Keynes because only very late in his intellectual career did he actually realise that Keynes was on the same side he was. He both based his work on Fischer and Schumpeter and Marx, never admitting Marx for the obvious reason that he was teaching and researching during the McCarthyist days in America. But Marx was very much his foundation. I know that for a fact from his own family. But he ignored Keynes. He thought he'd read Keynes in textbooks. And then in the 1960s, he read Keynes's book, a very short article, The General Theory of Employment. And if you haven't read that and you want to get a handle on Keynes, it's a 1937 paper simply called The General Theory of Employment. That's Keynes's summary of the general theory in 15 pages, effectively. And it's nothing like what you can read as textbooks on economics, and it's also very unlike most of the general theory except chapter 12 and part of chapter 17 and I think a bit of chapter 22. So it's Keynes distilling everything which was new about his theories. And when Minsky realised that, that's why he wrote the title of his own magnum opus on the financial instability hypothesis and called it John Maynard Keynes. So Can It Happen Again is the best. Very quick read. Long title one. Don't bother reading Stabilising an Unstable Economy. I just think he didn't have anything really new to say, and he spent 350 pages saying nothing particularly new. It's a very, very ungripping book. Okay, but here's from one of the chapters in the Can It Happen Again? He says the natural starting point for analysing, and notice this point here, the relation between debt and income. So he sees a relationship between debt and income, and that sets him apart even from most post-Keynesians today. It's a long struggle to try to get to the point where I prove that he's right about that. And then he said, in that particular time, you take an economy with a cyclical past that is now doing well. So it's essentially a cyclical model. He sees capitalism as inherently cyclical, and he's trying to explain those cycles from the financial point of view. So he said, in this cycle, you take a point, and again, this is like taking a set of initial conditions. He says, take initial conditions when the economy is doing well, but it has a cyclical past, and therefore, in that recent past, there was a debt crisis in the recent past. Because everybody remembers that debt crisis, both borrowers and lenders are very conservative about the amount of debt they'll consider taking on. Okay? But because the economy has recovered from the crisis to some degree, then most of those gambles that are levered win. Okay? Most of the positions, most of the investments, more investments succeed than people expect, given the circumstances, which means that people begin to revise their expectations, willing to take on more debt, more leverage. And then he says here, and this is, I think, a classic statement, the fundamental instability of a capitalist economy is upward. The tendency to transform doing well into a speculative investment boom is the basic instability of a capitalist economy. And that sets him apart dramatically from conventional Marxian-style critics of capitalism like Brown and Sweezy, who always argue, even Hilfening, arguing a stagnationist hypothesis about capitalism, which never made sense to me. I didn't see a system that stagnates, I saw a system that tended to become euphoric. And Minsky's argument, I thought, brought all those ideas together with a background in Schumpeter as well. Now, my own model of Minsky attempted to build a model of the financial instability hypothesis, and he used what all economists were using at the time, and far too many still use, difference equations, to model an asynchronous dynamic system like capitalism, and the model itself is invalid mathematically, invalid economically. If you actually convert it into a vector differential equation, you get an invertible matrix. So it's not a model. Okay? Most economists don't realise that, but it's not a model. So he failed to get a model out of it. And I built a model ultimately by taking the model of Richard Goodwin. Do you know Goodwin's predator-prey model of capitalism? Okay, it's a 1967 paper called The Growth Cycle. And what it is ultimately, it's inspired by predator-prey, but not derived by simply mapping predator-prey to an economic system. What actually happened, Goodwin was learning mathematics with a French mathematician who was a leader in predator-prey and looked at Volterra models.
What's the name of the book?
It's a paper called The Growth Cycle. Okay. Yeah.
Do you have references to this?
Pardon?
Do you have references to this?
Yes, and I'll just take a note of that one and I'll back it up on screen at the end here, and I'd certainly happily pass it around. Goodwin didn't write very well. He's a better painter and mathematician than he was a writer. So when I got my first exposure to this model was reading John Blatt's, I think, brilliant book called Dynamic Economic Systems. Have you heard of that one? Yeah. Okay. Have you anybody? Because I've got a PDF of that, which I'll happily pass around because he doesn't. It's out of print. So anyway, when I read it, I thought it was a brilliant model, but it didn't have finance. So I simply added finance to it. But now when I look at it, it's actually what it can be derived from is simply taking three definitions and expanding them dynamically. So if you define the employment rate as those with a job divided by total population, and the wages share as the wage bill divided by total output, and the private debt ratio as private debt divided by GDP, with those three definitions, simply take them and differentiate against time. And you get my model. And it ends up having these three basic statements to it. The employment will rise if the economic growth rate exceeds the sum of population growth and productivity growth. And that's the equation. And I'm using definitions there because they are strict definitions at this stage.
Employment rate, LN?
Yeah. The lambda is the employment rate. YR is real output. So that's the percentage rate of change of real output. A is the rate of growth of labour productivity, and N is the rate of growth of population.
N is population and
L is labour.
Labour.
Yeah, okay. Now, if you take the wages share of output, and omega is wages bill divided by GDP, you differentiate that, you find the wages share of output will rise if wage rises exceed labour productivity. And those are the two equations that define the Goodwin model, which, of course, being a two-dimensional model, is a limit cycle. It's actually a fixed predator-prey style cycle. I simply added in the third one, and that it came out with quite a complicated form, but it's only in the last year or so I've realised that it's actually incredibly simple in one sense, because all it says is the debt ratio will rise if debt grows faster than GDP. Okay? That's all it is. So those equations, you now have a set of definitions. So to make it operational, all I had to do was bring in expressions to relate output to wages and to the debt level. So the simplest was to say that real output is the capital stock divided by the capital output ratio. Sort of thing you could wake up in Modelica quite easily and have, as I heard yesterday, have causation go in several different directions. And then, again, a fixed relationship between labour and capital too. So output's a linear function of capital, labour is a linear function of output. Very, very simple at this stage. So when you then take and see what is the rate of change of output, you get this expression for the rate of change of output, and that comes down to output is a function of investment, which is the rate of change of the capital stock, and depreciation. Very simple expressions. Then gross investment, which is this term here, okay, I made that simply a function, a linear function of the profit rate. So here's a slope, the slope of a profit reaction function. Profit, and this is all in real terms here rather than nominal terms. I'll show you a nominal version later. So that's just a simple linear equation. That's the slope of the line and the zero intercept effectively of the line. Then profit is defined as output minus wages minus interest payments on outstanding debt. And change in debt, in this very simple model, I've got all borrowing being done to finance investment. So change in debt is investment minus profits. And so there's no Ponzi investment in this system. Of course, you can include that in the model. It makes it more unstable. It'll crash faster because this investment actually generates productive capacity which can later be used to pay back debt. But if you have simply Ponzi finance with households borrowing money to buy houses, it doesn't increase productivity. And then I bring in a linear relationship for wage change. Economists call that a Phillips curve after Bill Phillips, whom they never read, who was actually an engineer who tried to bring all these ideas across to economics back in the 1950s, by the way. So what we're doing in many ways is in the spirit of Phillips as well as in the spirit of Forrester. So a simple linear relationship for the rate of change of wages as a function of the employment rate. And then for population growth, yeah.
Before you leave this slide,
yeah.
If you were to include here some a little bit more complicated production function like cut values,
yeah.
What would you replace? Up there, output linear function, you would replace that one?
Yeah. And I'll show you.
Up there.
And I'll show you a suggestion I've got for that in the last slide here. Okay. And so in terms of when you look at the rate of growth of population and the rate of growth of labour productivity, they become alpha and beta. Alpha for the rate of change of labour productivity and beta for the rate of change of population. And you put that all together and you get this system. So this is a completely expanded out linear relationships, but of course it's an essentially non-linear model. Now I know this scares a few of my students, so I put this one up for effect. I know it won't scare anybody in this room. And there's, in fact, when you look at it, you can see it's a three-dimensional model. Okay, linear components, three-dimensional, which is the same basic class as Lorenz's model, which is intriguing because of some of the behaviours of the system I'll show you in a moment. So there's potential for chaotic behaviour, of course. Once you have three dimensions, I don't need to tell anybody in this room what that means. And there's inherent nonlinearities there. And again, that's something you're all familiar with. Again, some of my students don't know what I mean by nonlinearity, so I use a little joke from the Big Bang Theory about what happens when you multiply one person by another. Okay. And then what you've got going on there when you take a look at the expressions, there's in the first equation you've got population rate times the negative of wages share in the debt level. The second has wages share times the positive of the employment rate. And the third term has, against it's positive in both cases because it's minus d multiplied by minus omega and minus d itself. You've got a genuine quadratic there plus another quasi-quadratic. So plenty of potential nonlinearities in the system. And it ends up having three equilibria, of course. And when I built the model, all I was trying to do was to simulate a debt crisis. Because I saw a cyclical progress towards a crisis. That's what I wanted to generate. Now, there was nothing in Minsky's model that suggested what I saw as the qualitative behaviour of the system would actually happen. So I'll show you that in a moment, because there are three equilibria. One is what you call a good equilibrium, the other two are bad, both involving infinite debt. Zero wages, zero employment, infinite debt, which can be positive or negative. This one here, this is you stabilise towards the good equilibrium, as Matthias Grasselli calls it, my friend and colleague from the Fields Institute. So this is employment. You can see it's heading towards an equilibrium. The same applying to wages share. Though notice the wages share is trending down as well as heading towards an equilibrium. And what you've got happening with the debt to GDP ratio rises in a cyclical fashion but tapers. And you can see it's hitting that's 60% of GDP over here as a ratio of private debt to GDP. So that's the good equilibrium. And when you put it together, you get the sort of shape you might expect. Okay. Again, economists wouldn't expect that because they expect an instantaneous jump to equilibrium and all that sort of nonsense. But here you can see you've got a stable set of eigenvalues taking you towards in a cyclical path taking you towards a point equilibrium.
What's the time period of the oscillation?
Oh, it's huge. I mean, because it's a linear model, this is 200 and something years, 300 years. When I bring in a non-linear... Oh, no, the cycle's about 4 years.
Okay.
Yeah, if you go to take a look at the cyclical period there, you can see there's 100. You can really count them. It's about 20 or so. So about every 4 or 5 years. Even with a linear equation, the time dimensions aren't too bad. Of course, it gets better when you have nonlinear relations there, because you'll have a nonlinear wage relation, a nonlinear profit relation, and so on. And of course,
each of the peaks and valleys there can be interpreted as
a boom and a bust. Yeah.
In
More so.
Very, very shocking for the economic system, right? We don't want that.
Yeah.
It's very regular. It's like an oscillator with the same frequency.
Yeah.
And business cycles.
Yeah, they're business cycles, basically.
Yeah. I just want to ask why you specifically refer to passive capitalism.
Pleasure what?
You call this convergence equilibrium with passive capitalism?
Oh, yeah. You'll see why in a moment. Okay. Because what I have, the factor which is giving me this particular shape is the slope of the profit function for the capitalists. So if I have a slope of 5 here. So what they have is there's a target rate of profit, which is, say, 3% rate of profit. And for every percent that the profit rate is higher than that, they invest 5 times that much difference as investment. So a slope of 5 is the approximate idea about their conversion of excess profits to the amount they're willing to invest, and therefore they have to borrow to do it. If I make that 6, so it's that's why I'm saying slightly more aggressive capitalists, this is what happens. So it looks like you've got diminishing cycles, and they start to rise again. Does anybody recognise where that comes from? Ever seen a pattern like that in a dynamic system before? Some of you should have, I imagine, if you work in fluid dynamics.
It's a modulated oscillation.
No, it's actually more severe than that. I forgot to include one of the charts. I'll talk about it rather than bring it up. But notice what's happening. You've got diminishing cycles and then rising cycles. Okay? And what's actually going on behind is the debt ratio doesn't stabilise. Okay? And the peak level is now 300%. By changing that slope, I go from 60% as the equilibrium. Now it's up to 300% and still rising in a cyclical fashion. When you put it together in 3 dimensions, that's the shape you get. So if you're just looking at employment and inflation, which is what the neoclassicals look at because they ignore the debt level, they see convergence. To them, that was the great moderation. Okay? Now, to me, it was a signal that my model was actually happening in the real world, which was quite a surprise. But I don't think I've actually included the chart. I've got to check and see. No, I forgot to include it, but I'll talk about it. If you've seen Pomeau and Manaville have a paper called The Intermittent Path to Chaos. And if you look at the Lorenz equations, that's why I mentioned the Lorenz equations earlier, there's a particular dynamic process that they show using a Poincaré map, where you have basically a straight line and a curve. Well, if the straight line intersects, the curve intersects in 2 places. The bottom is a stable equilibrium, the top is an unstable equilibrium. If the line is at a tangent to the curve, or doesn't quite intersect, then you get oscillations which diminish. So you're going from turbulent flow to laminar, but then on the other side you start going from laminar to turbulent again. So it's one of the phase transitions in fluid dynamics identified by Pomeau and Manaville, and it turns up in this model. Now, I'm still amazed that it happens, because that implies that's the pattern you'll find when there's a financial crisis going on. And now looking back at the data, this is data I've only acquired after the recent financial crisis, but this is looking at the dynamics of inflation and employment and change in debt and the level of private debt back in the 1920s to the 1940s in America. That's starting in 1922 and going to 1932, so 10 years. And you can see the blue line is the inflation rate. Now, there was all sorts of volatility there at the beginning, courtesy of moving in and out of the gold standard back after the First World War. But you'll see that there's a trend, there's a trend for that to be diminishing over time. The employment rate was incredibly low, but that was also tending to fall. And in fact, when the Great Depression began, the NBR with this data was recording how many people were actually registered for the dole, but there was no dole. They were registered as unemployed. Back in 1929, it was literally 0 as a percentage of the American population. It was that low when the stock market crash occurred. Then you have unemployment blasting up. Here I'm showing it up to 18%, but it actually hit 26%. And inflation went to minus 10%. for a couple of years. So that was the 1920s and 1940s. Now the data we've just been through recently, of course, is much better recorded. And this is the pattern we saw. The cycles in inflation and unemployment were diminishing. The black line is change in debt as a percentage of GDP. So what you've got, and the orange line is the ratio of debt to GDP. So what you've got is a rising contribution from credit. Change in debt I see as credit. Okay. Credit being demand generated by debt. Change in debt is credit. And that's the ratio of debt to GDP. It's the same basic phenomena we saw back in the 1920s for America. And if you look at Japan, the same pattern applies for their crisis. This is between 1974 and 1994. When the crisis began, they had an enormous increase in private debt. So the rate of growth of private debt was hitting 30% of GDP in 1990 before it began a long decline from there. And you went into a crisis which was more gradual in the Japanese case than, of course, the 1920s, for the same basic phenomena. And you can even find a similar pattern in England. So I think this particular pattern of diminishing cycles before a debt crisis is a common phenomenon, and there's a logical reason behind it, because if you think about the society in a three-class structure, workers, capitalists and bankers, and you start with bankers having a low share of GDP because their share of GDP depends upon both the rate of interest and the debt level. Okay? Now, in all these situations, both the data, my simulations, I start from zero debt, and the real world, in the American case, you started, let's say, the 1945 post-war period, you started with a debt ratio of about 30%, 40% of GDP, and it rose from that to 170%. So increased factor of 5. Interest rates back in the 50s were much the same as they are right now. Okay, they got to be very high in the 1990s, but generally speaking, the rates we're seeing now are not too different from what we were applying back in the 50s for commercial rates. So their increase in wealth is a factor of 5, because with much the same real interest rates, they've got 5 times as much debt. So their income share rises. Now, if their income share rises, one of the other two shares has to fall. Okay? And when you look at it, which again was quite remarkable in the model itself, the share that falls is the workers' share. Okay? And the logic I see behind this is that the system is investment driven. Capitalism, investment decisions determine the rate of growth of the economy. And they depend upon their profit that they're getting back. So if you have a relationship between profit and level of investment, that's a determining feature of the level of output. And by the way, Marx this is actually a model that comes from Marx. It's in chapter 25 of volume 1 of Capital, published back in 1867. And Marx made the same point. He said the wages share is the dependent variable, investment is the wages share is the dependent variable, investment is the independent variable. And it turns out he's quite right. When you solve for it, investment determines the profit rate. The profit rate is affected by the debt share, and the wages share drops out as a residual. So a rising level of debt means a falling share going to workers, and therefore rising inequality. Which is one reason I was saying yesterday we should have a three-class model when we put this whole system together. So when you look at the rest of the world, what's happened elsewhere? Well, the countries that didn't have a crisis back at the time of the global financial crisis are getting ready for one now. This is data from 8 countries. 7 countries of about the 18 that I've identified using Bank of International Settlements data as countries that are likely to have a debt crisis in the near future, because having survived the global financial crisis, they've continued having growing levels of debt. And one of those countries is Sweden, which is running at 240% of GDP as its private debt level. Norway is pretty much the same. And then you've got China, which has gone from 120% to over 200% in just 6 years. Australia, Canada, and Korea. So that's
basically an increase in percentage of GDP representing debt, pushed by investment, which is the main driver. Or
Ponzi investment, housing bubbles. Yeah, particularly for China and Australia and Canada. Sweden and Norway? I'm not sure. Yeah. Well, this is what's driving it. So
we have from an increasing crisis, but there hasn't been that much houses built, so there's a kind of shortage of.
Yeah, it's still. I've actually done I don't. Granger causality is a very linearized system, but I've done working with a colleague in England, Paul Omron, and his research assistant, whose name I can never try to drag out of the back of my brain, but I think he actually is Swedish. Three of us together have done the Granger causality on the relationship between mortgage debt and house prices. And my hypothesis was that accelerating mortgage debt is the driving feature in change in house prices, and it's been confirmed by Granger causality, which with such a nonlinear system, to get a linear test saying your causality goes that way, it's pretty emphatic. So house building is a very secondary issue. The main thing is the demand, which comes from the monetary and debt side.
It's so cheap to borrow money.
Pardon?
Yeah, it's so cheap.
Yeah. And because people are borrowing because they expect to see capital appreciation. When you separate out housing debt into secured and unsecured, there's no particular trend to unsecured debt, credit cards and stuff like that. People don't take on too much because they don't expect to sell the car for more than they paid for it. But in housing debt, they can get caught up in the bubble, and there's a positive feedback loop between the two. So, just to show another little curious feature of the models is again back to the linear model. And it's very hard to see the text here, but what I have in this particular simulation, this is where there's the slope of the profit function, of the reaction of capitalists to the rate of profit is 5, and that gives you an equilibrium debt level of 60%. Okay? Now, if I increase that to 6, the equilibrium level of debt goes to 150%. So it's very sensitive to how sensitive capitalists are to the gap between actual profits and desired profits, and how much they therefore invest as a result of that. And of course, you'd think with capitalists being more aggressive, more willing to invest, you get a higher growth rate. But because you get such a higher share going to bankers, because debt's 2.5 times larger with more aggressive capitalists, you actually get the income distribution shifts away from workers and capitalists towards bankers. So bankers go from having 2.4% of GDP in the low capitalist investment to 6% in the slightly higher desire to invest, and the growth rate actually drops. You go from a 2.8% rate of growth to a 2.5% rate of growth, with capitalists who are more willing to invest, because the impact of that willingness to invest is a shift in income distribution towards bankers and a lower overall level of investment. Yeah.
You put there a strong sensitivity of debt to slope of investment function.
Yeah.
Do you interpret slope as changing from growing slowly to start growing? Growing steeply to changing to growing but more slowly.
No.
There's a change of the second derivative there that some interpret it as a signal to market, that many can interpret as this was growing really fast and now is.
No, it's actually it's a totally linear function, totally independent. Okay, and when I bring in when I do more modelling, what I've stuck with as much as I can is straight exponential functions for relating wages change to employment rate and investment to the rate of profit, because I don't want to have a functional formula that actually forces the outcome of the model. So if I have a set of exponential functions interacting with each other, nobody can say I've actually tailor-made the functions to generate the results I want. And the reason I'm using linear here is A, for clarity, because you can do some symbolic work, of course, with linear functions, but also looked like I was going to get funding for developing Minsky further from the New Zealand Central Bank. And I was shot down by a little asshole neoclassical recruit to the place from Sweden. I'm very happy to call him that in public. He was extremely rude. And he'd been in the bank a total of 3 weeks. And he was so aggressive about what I was doing and so anti doing anything other than a DSGE model that his zealotry meant the bank decided not to support what I was doing. And he's saying, you only get those results because you've got exponential functions. And I was saying, listen, mate, I wrote the effing model. I know that's not what caused it. I know it's, if I had linear in there, I'd get the same result. So I now do and show the linear first of all before I show the exponential form, to show that the dynamics that I showed you earlier are structural. It's not a case of the functional form actually mattering. So And this is just showing exactly the same thing happens if there's a same slope but a lower desired level of profits. If capitalists are happy with a lower rate of profit but have the same reaction function, you have the same basic dynamics, an increase in the share going to bankers and a decline in the growth rate. So again, these are perverse effects. Now, part of what one reason neoclassicals don't even consider this is they argue that borrowing has no impact upon the economy. And this is Paul Krugman, my favourite neoclassical. He'd object to being called a neoclassical, but he is one, who argues there's no link between the level of debt and the level of money in the economy. It's simply a transfer of money between patient and impatient agents. And in my own circle, which is largely the post-Keynesian, I prefer to see myself as a complexity theorist in economics, but I'm certainly aligned with the post-Keynesian school in general. They still can't see a role for credit in demand. So this is taken from a primer on what's called modern monetary theory by Randy Ray. And he says he starts from the macro accounting that spending equals income, which is one of the accounting identities in modelling capitalism. And I'm arguing for all the way through, I'm arguing for the last 10 years, that there's a role for credit in aggregate demand. And that's been interpreted, and the way I've stated it myself on occasions too, as if there's a difference between income and expenditure. And I was trying to rationalise in various terms like Lebesgue integrals and what happens first, etc., microsecond type timing issues. But I finally realised that to be correct, I'd have to convince this group and convince myself using the identity of expenditure being equal to income. So I want to take you through the logic there. And what I've done in this particular argument is to take the economy and divide it into three sectors, S1, S2, S3, plus a banking sector, and then have expenditure shown in its table from between each sector to the other sectors. So the diagonal is the expenditure by each sector, and the off-diagonal is the receipt of income by each sector. So when you put that together, and I've got this in dollars per year, I need to explain this in great detail to economists, but I think you can understand talking flows of dollars per year here without much trouble. I show flows in lowercase, the one stock that exists in uppercase, and because I'm using lowercase Roman for the flows, I'm using rho rather than R for the rate of interest. So if you have a case where there's no borrowing or lending, then A plus B is the flow from sector 1 to sector 2 and sector 3, and C plus D from sector 2 and E plus F from sector 3. And of course that's when you take the negative of that, there's aggregate expenditure. The positive of that is aggregate income. They're necessarily equal to each other. That's the basic logic. Now when you generalise that and say, well, let's now take a look at the neoclassical idea that lending is from one non-bank to another non-bank and all the bank does is arrange the loan. That's their vision of lending. Then sector 1's borrowing from sector 2, and of course since it's borrowing a flow of dollars per year, there has to be an outstanding stock of dollars debt at any point in time. So they've got to pay interest on that, which is going to be rho times L. And intriguingly, I don't think the neoclassicals realise this, when you do that, even though the lending by one, the flow of lending cancels out the flow of borrowing by the other in terms of aggregate income and expenditure, the debt financing turns up as part of aggregate income and aggregate expenditure. So you've got to include gross financial transactions as part of aggregate demand, even in loanable funds. Now when you take the case where you actually have banks doing the lending, which is the real world, that neoclassicals are trying to deny all the time, then I have sector 1 borrowing L dollars per year from the banking sector and paying interest of rho times L per year to the banking sector as well. So I'm now including the banking sector in the analysis as well, so I've now got 4x4 rather than 3x3. And when you sum up that, you get, as you can see, the flow of credit turns up as part of aggregate expenditure and part of aggregate income. So it's quite consistent to argue that, where does my mouse has got to, I'm trying to bring the mouse up, it's quite consistent to argue that credit is part of both expenditure and income, and identical in both cases. Now the way to handle that, logically, is to say that expenditure consists of demand from money we already have, plus demand from money newly created, which is being borrowed to be spent. Okay? When you borrow money, you go, I've just purchased some deodorant because I managed to leave my toiletries back in London, and I used my debit card. If I was using a credit card, I would have created expenditure by me and income for the shop instantly in doing that. So It's instantaneous creation of both income and expenditure out of credit, and you have to add the two together, and that gives you therefore it's a dissipative system, not a conservative system, which is a big mistake a lot of non-economic modelers make, as well as economists themselves. And you can measure it as a flow of goods per year. GDP itself is a bad measure of the instantaneous flow of goods per annum being produced, which you can see as expenditure out of existing money, whereas change of debt is expenditure at a point in time financed by the creation of new debt and therefore new money. And it's dimensionally accurate to add the two together. And the analogy I give to economists to make it a bit easier for them to understand is, say, imagine you're trying to measure the flow of water in a river where there's a pump that can pump water in or out of the river at a particular point. Then your flow is going to be the flow of water already in the river plus the flow coming in or going out from the pump. And that's both dimensioned in dollars per year. So it's quite valid to add the two together. Follow that? In this room certainly would. Okay. What you can then use is add GDP plus credit together to work out aggregate demand and aggregate income plus realised capital gains, because most of the money that's borrowed now is borrowed to finance speculation in asset prices. It gets into the monetary circulation for goods and services as a side effect of people speculating on houses. So this is what I'm calling my smoking gun of credit. And we have the red line is GDP on its own, along here. Pardon me making a bit of a marker. The blue line is GDP plus credit, and the black line is, which they're both graphed on this axis. I haven't actually used this pen before giving a demo. It's rather cute. And this one is percentage change of credit as a percentage of GDP. So you can see for Japan, that was running at 30% of GDP, and its crisis began when that started to slow down. And even though GDP continued to rise for some years, GDP plus credit was falling across that period. Why isn't it writing this time? Hang on. Maybe I ought to do that. Let's see. Where's it got to? What a drag. Maybe I've done enough, it won't do any more. Okay. Now, if you look at the average of credit growth before the crisis, it was 18% of GDP. Average of credit after the crisis, minus 1.8%. Now, again, if we're talking about trying to change the direction, the ecological direction of capitalism, we're going to be doing it in a context where most economies in the world are going to have negative credit growth, lower negative. So demand's going to be in a slump. This is the USA, by the way. Same basic story. The crisis began here. Why is it not working? Damn, that was really cute. Oh, I can't get it up. Okay. Can't get it to work. Okay. And then the same story. Crisis begins when the sum of the two starts to decline. And before the crisis, 11% per annum. After the crisis, 3.7%. And I think it's going to go lower than that over time. It won't continue rising. So now we want to start talking a bit about Minsky and why I developed Minsky. And part of it was because to try to design models of financial flows is really complicated using the flowchart paradigm, because to properly record financial transactions, you actually have to record them 4 times. Okay? Once between the parties and once between the agencies with which those parties bank. So if you look at what the neoclassicals do, they say, well, it's all on the liability side of the banking sector. The saver lends to an investor, the investor repays the saver, everything is shuffled on the liability side, nothing is happening on the asset side for the bank. Whereas the post-Keynesian argument is to say that lending is between a bank and a non-bank, and what happens is when a bank makes a loan, it increases its assets by the loan and it increases its liabilities by the deposit. Whether that occurs in your account or, if you're buying a house in the deposit account of the person you're buying the house from. And equally when debt's repaid, and I took a while to realise this myself, when debt's repaid, bank liabilities fall and bank assets fall, so the amount of money also falls in the economy. Now that's an essential difference, and the neoclassicals argue that it isn't. So what I've done with Minsky is build what I call godly tables, and they let me show financial transactions using double entry bookkeeping. So if you look here at the consumer goods sector model here, this is modelling loanable funds, which is the neoclassical fantasy. And what I have here is the consumer has 2 assets, the deposit account they've got at the bank and debt. And then the investment sector is paying them interest and repaying the debt. etc., etc. So all the financial transactions occur between the consumer sector and the banking sector and the investment sector. The banking sector is just being passive. So if you look at the banking sector here, okay, I've got the lending and the repayment, the interest turning up there, but they're just as transfers between liability accounts. There's no asset for the bank. The bank doesn't have any asset apart from reserves, and as you can see, nothing is happening on the reserves there. So when you simulate this model, and this is one useful thing with dynamic modelling, put your opponent's logic into your format. So what I've done here is I've taken that fantasy that banks are just intermediaries rather than loan originators, and when I simulate this system, it rapidly converges to equilibrium. You can see the growth rate is pretty much zero here. GDP is flatlining, and I've got slider controls here that I can vary while the simulation is running. So this is making lending happen more rapidly, and notice the growth rate falls, and repayment more slowly, so the growth rate actually falls even further. And notice the debt to GDP ratio is rising quite significantly, but basically in Australian French, bugger all has happened to GDP, and the growth rate is still running at zero. If I then go rapidly back towards very fast repayment, growth rate actually accelerates, and slow lending, the debt ratio falls. You get a couple of minor effects on GDP, which then are transient and disappear. So their point of view is to say, well, banks, you can forget about them. Okay? And institutionally, if their structural model was correct, they'd be right, because it has a trivial impact on the overall economy. You can forget about it. Now, what I can do with Minsky, and this is why it's much more effective than trying to do this with a standard system dynamics program, I want to go from this model, which is fiction, to the real world. And that would take a bit of rewiring, as you'd all understand in Modelica or anything else. But in Minsky, what I can do is come across to the consumer goods sector and just delete that column, which has this myth that the bank, that the debt is an asset of the consumer sector. When I delete it, I can then also delete the lending and the debt repayment and the interest payment and the bank fee operations. And I can go across to the banking sector and create a new column. And now the program remembers that there's still an existing liability there, which is now unallocated. So if I click on the down arrow here, once I bring my mouse back up, where's it got to? Click on the down arrow, there's debt. If I click on that, it brings across the payments, the operations, they're still there. And all I need to do now is add in that the interest payments are made to the bank. Just going to move that. I hate the fact that it's only 1 pixel wide and you've got to grab it to expand it. Okay, so I've got to now, and notice what it's showing over here in the row sum is that there's this, all the row sums should be 0. So I've got to type in a minus int there, and that will make that 0. So that's ensuring consistency between the different accounts, which is the major advantage this has over a standard system dynamics framework. I'm just going to delete the bank fee, which is a fiction of neoclassical imagination, reset the system, and start with the same initial parameters. And you notice we now have a positive rate of growth and a growing GDP. Okay? And if then I then increase the rate of lending, GDP grows more quickly, so does debt. Slow down the rate of repayment, growth rate goes even higher. And then if you have a speed up in how fast debts are repaid and a decline in how fast loans are made, as well as having a declining level of debt to GDP, you also have a slump in the economy. If I restore it back to again, you've now got a rising debt level and a change in the money supply. So it's extremely easy to illustrate live and quickly to someone that debt matters. Okay? The dynamics matter, that money matters. You can't ignore them in modelling capitalism. So that was a major factor behind wanting to write the software in the first place. So that's what I've shown you there a moment. I've got a little movie there, but I don't. It's always a danger to show a demo live, as you all know, but that one worked. So I'll keep going. Okay. So other features of Minsky, it's written in C++ and TCL/TK. Neither Russell nor I knew about Modelica as a programming language at the time we wrote it. If we had, we probably would have used Modelica. I'd always seen at that stage was XCOS, which if you know XCOS is the Simulink clone inside Scilab. I thought it was a dreadful interface. Yeah.
Can you wrap up in 5?
Yeah, sure. Okay. Live simulations, as I've shown you a moment ago, you can type latex in directly, and you can type directly onto the canvas. So if I bring up this, if I just type here and type to go for omega, then I get the symbol coming up on screen. I can type a plus key and a multiplied by key and a minus key, etc., etc. So you don't need to go up to the and you can also overload, by the way. If I have let's say I have lambda here, then we have overloads on all the operations where you can have overloads. It's also converting to equations. You won't see them over here because nothing has actually been completed yet, but it generates the equations at the same time, outputs them that way. And if you saw the graphs are live on Canvas, and we have it set up so you can do XY charts by just feeding the wires in the bottom here. So you can have up to, if you wanted to, up to 8 simultaneous XY plots, which would be crazy, but you can do it. And I want to go further to having flowcharts to equations and equations to flowcharts rather than just one directional, and multi-sectoral modelling and multi-country is a major ambition to get there. But it'll take a while. And pardon?
Many countries affecting each other.
Yep. Now, to show you a more complicated, the model I showed you a moment ago didn't have. This is the equations for a model that includes prices. So I'm going to show you the same Minsky model as beforehand, but with prices inside there as well, and variable interest rates and so on. And the intriguing thing about that is that the model I showed you beforehand had complex cycles going. The cycles of boom and bust were equal-handed. This is now a model with price dynamics as well, and what you find coming out of this is quite fascinating. Oh, great! I'm going to see if I can ignore this. This is a bug I thought we'd got rid of. We haven't quite. Okay, it's working all right. Okay. And what you get in this model, this is the employment rate, and this is the profit share, and the debt ratio. And you can notice diminishing cycles in employment, then rising cycles, and then just when the cycles seem to peter out, it looks like you're back to equilibrium again. This thing you've been ignoring down here starts to go exponential. The economy collapses. It's all a one-way direction, not the two-way of the price model. And the last people to realise capitalism is coming to end are the capitalists, because for a long time their declining amount they're paying to workers is being offset by a rising amount they're paying to banks. But when this starts to go exponential, that's the end of the system. Good night, Josephine, for capitalism, which is largely what we've been through, except for government spending. So I just want to finish with one thing, and that is, I noticed one of the models had an idea of generalising a Cobb-Douglas production function to suggest energy as the third input. I don't think that's the right way to go about it, because all I have to do is set alpha equal to 0 and goodbye energy from your model. It doesn't play an essential role. So the insight I've had recently is that it's crazy to even talk about labour and capital without energy. Labour without energy is a corpse, and capital without energy is a sculpture. So they're both effectively vehicles for harnessing free energy. And what I then say we can show them is they're turning embodied energy, which they each have to function, into work. So work by labour is going to be how many workers you have, times the embodied energy per person, times the energy output per energy input per person. And I can put that in symbols, and to have a labour times the embodied energy times the efficiency of exploiting that energy and turning it into a useful work. Exactly the same basic concept for machines. And then when you do your maths on that, you get your Cobb-Douglas out the front, but you get terms that essentially involve energy as the rear terms. And you can largely regard the energy from labour as a constant. Of course, the energy in a machine is variable, and that's what's been increasing dramatically over time. That's where most of the increase in productivity has come from. So that bit there effectively is a solo residual, and it now attributes the whole solo residual to a better exploitation, more efficient use of, and larger use of energy, largely coming out of machines. And I think that would be a better production model to use than what we've used so far. I'll leave it at that.
All right.
Okay.
Thank you.